Hello everybody, surprise! This is AK. I'm back. I'm taking a break from my long break to bring you this video because the people would say that my long break is too long. So I think one video a week is not too demanding, so it's a compromise. Okay, so not going back to daily videos, but maybe one video a week, longer one. I didn't say why I'm taking this long break. Okay, just to put all the speculations to rest. I'm making some big lifestyle changes, and I know from past experience that it will make me quite irritable, uncomfortable. So I decided to take a break from social media for a while, right? Stop making blogs and videos for a while, just to concentrate on those changes. But I'm sure you're not here for the details of my lifestyle changes. So let's go on to talk about the things I want to talk about on the money and investment front today. First thing, ST Engineering, right? So long-time readers of my blog would know that ST Engineering is one of my oldest investments. I started buying stocks of ST Engineering donkey years ago when I was a young working adult at I think $1.51 a share. Back then I thought it was a very good investment for income because it was sitting on $2 billion in cash. It didn't know what to do with all its earnings, so it paid 100% of its earnings to shareholders, right? So I thought it was perfect. And based on my cost price, I mean the dividend yield today I think is probably 10%, around there. For blue chip, that's fantastic. But and of course over the years since my first purchase, I was averaging up. I was buying at higher and higher prices, and I remember people asking me why are you doing it? It's more expensive now. I say, well, the price is higher, right? The prices were higher, but it didn't mean that the investment became more expensive, right? Because it became a more valuable company, right? I've said it's okay to buy something at a higher price than what we paid before if the company has become a more valuable company, right? So the same thing applies to my experience with ST Engineering. And ST Engineering reported 18% rise in group revenue, right, to $2.7 billion for first quarter ended March 31st, right? This was in its business update. And it's fantastic results all around, right? But of course, if you have been following my videos in the last few months, you'll remember that I say the concern that we should have with ST Engineering is very high net gearing, right? Its net gearing is in excess of 200%, which is very high. It's like 234%. So this is very different from back in the days when I first started investing in ST Engineering, when it was sitting on $2 billion in cash, net cash. Right now it's in a net debt position, right? And you have to ask whether you want to invest in it today. Price to book 5.1 times, dividend yield is only 4%. I say only 4%. Some people say, oh, but 4% is like what you get in the special account. But the special account is risk-free. Is volatility free. There's no price risk, right? It's not the same when you buy stocks. There's some risk. There's definitely volatility, right? There's price risk. So it's not apple to apple comparison. Okay. So but like I said before, borrowings or debt is a double-edged sword, right? So if used judiciously, it can help to propel earnings, right? And if all the stars are aligned, so ST Engineering apparently has a tailwind. Its order book is very strong, $27.7 billion, and its net profit also improved. Revenue improved, net profit also improved. Some companies revenue goes up, but they are actually losing money. But not in the case of ST Engineering. Net profit improved 13.2% year on year, and its net earnings could increase 14% year on year for the full year, right? So as long as cash flow continues to be healthy for ST Engineering, as long as its earnings continues to improve, then the very high gearing is less of a concern, right? The issue is, what we fear is that if its cash flow should dry up, then we might see an issue, right? But for now, okay, should you invest in ST Engineering today, right? Well, it's a dividend yield of 4%, and when it comes to capital appreciation, I mean, if you are a trader, I don't see how there could be much more upside. So for 4% yield, I think there are safer investments, right? That's my point, right? But someone who's already invested like me, I mean, my investment is free of cost. I'm quite happy to hold on to it. Okay, so that's ST Engineering. And next thing we want to talk about is, surprise, Bitcoin, right? So Bitcoin's price has gone up a lot, and of course, if you have been following my blog, you know that I've said before that Bitcoin is not an investment, right? Bitcoin can be used if you can trade Bitcoin, but you can't invest in Bitcoin, right? There's no fundamentals, you can trade Bitcoin. And personally, I've bought Bitcoin because I think of Bitcoin as digital gold. So just like holding some physical gold and physical silver, which I do. So I think of Bitcoin as insurance, right? Digital gold. So the Bitcoin price has more than doubled from the price I paid some time back. And some people might be wondering if they should buy Bitcoin now. So because the price has gone up, and the gurus will say they'll go up even higher, right? So if we look at history, the last time Bitcoin had big rally, and this is from Channel News Asia, was because of the retail investor. There was a lot of fear of missing out, FOMO, and the retail investors came in and pumped up the price of Bitcoin, right? And of course, eventually the price crashed for various reasons, but the price went up because of intense FOMO, right? And but this latest rally for Bitcoin apparently was driven mostly by institutional investors because of US Bitcoin exchange traded funds which were launched. So not so much because of FOMO from retail investors. So they say Bitcoin this time should have more staying power. I don't know. I think it's all very speculative. But I do believe what Mr. Ray Dalio said, and that is Bitcoin has a very strong network effect, and now that it has gained legitimacy, right? And ETFs have actually formed around Bitcoin. I think we have to accept the fact that Bitcoin is here to stay. But I still look at Bitcoin as an insurance against fiat currencies. I don't think of it as an investment. So if you believe in that kind of thinking, then having some Bitcoin isn't a bad thing. But I got it at a much lower price, very much lower price. So it's not something that is a must-have, I think. So you have to ask yourself if you are comfortable with paying a much higher price today. Definitely don't anchor at my price, because there's no fundamentals per se. We can't say whether it's undervalued or not, whether we can buy it now or whether it'll become more valuable in future based on fundamentals. So, but I would stick to good old physical gold if I'm not feeling comfortable about paying a higher price for Bitcoin today. Okay, so the third thing to talk about is ComfortDelgro. Right, ComfortDelgro, of course, is also one of my older investments. I have it in my CDP account and also my SRS account. The last time I got into ComfortDelgro was during the pandemic. Right, during the pandemic, I think I can't remember what's the price I paid already. It was close to $1 per share. Very depressed prices at the time. I blog about it. And ComfortDelgro reported first quarter 2024 earnings of $40.6 million, which is up almost 24% year on year. fantastic. And today I received, I saw the dividend for ComfortDelgro came in my bank account, so that makes me feel even happier. I would invest in companies which are sitting on a cash pile and is generating income anytime. And I've made videos about ComfortDelgro before about how we were sitting on $1 billion in cash. It was sitting on actually $1 billion in cash, and it was still profitable and churning out free cash flow and paying its investors. And I've said before, I would rather invest in a company like this than in Grab anytime, right? At the time, of course, Grab was burning cash, and it was burning cash for years and years. And there's no point in throwing money into a company like that. And also, it didn't pay any dividend. So it was basically like a leech, sucking blood from investors. I shouldn't say that since Temasek an investor in Grab. Oh, never mind. Okay, so ComfortDelgro, I'll provide a link to one of my past videos in the description box below, right? And next thing I want to talk about is net worth and salaries. Of course, these are two topics which not just Singaporeans, many people are obsessed over, right? They like to know, oh, what's my net worth compared to the national average? Whether my salary I'm drawing now, the salary, is it above what the average that my cohort is drawing? And I don't know. I find all this comparing very tiring, right? But if we must compare, I would rather compare what's our total cash flow. Right? If we must compare, I mean, I have a video which I made before that has a very strange title that says, "Don't be rich, don't be cash rich, be cash flow rich." Right? So if you watch the video, you know what I'm talking about. Otherwise, I'll provide a link to the video in the description box below. What's the point of knowing what's your net worth, whether your net worth is above national average or something? I mean, the trigger for this, for talking about this, is because I saw recently videos about net worth again, and where are you, whether you are in upper middle class in the country or not, that kind of thing, right? And I've said this in some blog posts before. You might be just middle class, but you could actually be more. You could be in a better position to retire from your job than someone in the upper class, for example, right? Someone might have a very high net worth, but or his net worth is tied up in his property, for example, and his home that he stays in, and he doesn't generate any cash flow for him. Okay, so now we have an airplane flying over us. Okay, it's gone. So whereas we might be staying in a HDB flat or a small apartment, and then our investments generate a lot of income for us, right? Passive income. So our cash flow could be stronger, right? And then of course there's, if you talk about salary, I've said this before, someone could be making $10,000 a month, $50,000 a month, but he spends every single cent of it, and maybe he even use his credit card to buy things with money that he doesn't have, right? So what if his salary is higher? And if someone is making $5,000 a month, but then he saves $3,000 and invests that $3,000 for 6% dividend yield, right? In time to come, his cash flow could be much stronger than someone who is making 5 times, 10 times more in terms of salary, right? So I think you don't see people making videos or writing blogs or having news articles about how much is your cash flow per month. They always talk about what's your salary, what's your net worth. I think it's leading people down the wrong path, right? It's encouraging, or it's not encouraging, but maybe it's just catering to what readers want to read, what viewers want to see. But it's not helpful. It's not helpful, right? I look forward to the day when more people talk about cash flow. Okay. Anyway, talking about cash flow, we want to invest in the correct or genuine income producing assets, and we want to be very careful when it comes to the balance sheets, right? And I've said this before, and I just now talk about it when I talk about ST Engineering and ComfortDelgro. Balance sheet strength cannot be overemphasized. It's so important, and that's one reason why I say avoid investing in Manulife US REIT, right? And of course, when people ask me about prime US REIT as well, I say, well, they're on the same boat, right? And now in the news, it says that prime US REIT is divesting assets at below valuation because it has to focus on reducing leverage, right? So basically, its balance sheet wasn't in a good position, and now they have to sell assets at below valuation in order to reduce its gearing level, right? So I've said before that this is a sign of distress, right? Just like Manulife US REIT, they are in distress. It's very different from the case of Sizen REIT, like many years ago when I invested in it, right? Because Sizen REIT was able to divest assets at above valuation, right? 10, 13, 17% above valuation. The REIT wasn't in distress in that sense of the word. In that sense, it wasn't in distress, right? But it's just that it had to, because it was a credit crisis, and the banks or the lenders required them to reduce their borrowings, right? It was a credit crisis. Whereas in the case of Prime and Manulife, there's no credit crisis. In the general sense that there's no credit crisis, it's just that nobody wants to lend them more money because they are in distress, right? Whereas back then in Sizen REIT's case, every single REIT had trouble borrowing money. It was a credit crisis that seized the entire world, right? So remember, balance sheet strength is very important when we look at something and whether we want to invest in it. Balance sheet strength, right? So the last thing I want to look at is or to remind myself about is T-bills, right? So the T-bills up for auction again is happening, 6 months T-bill auction happening next Thursday. So if you're building a T-bill ladder, strengthening your T-bill ladder like what I'm doing, remember to put in your bid. I think non-competitive bid is fine if you're using cash. If you're using CPF, well, this T-bill auction is happening second half of the month, and it's possible that when does it mature? Let me take a look. The next T-bill auction matures 26th of November. So there could be enough time for us to do a transfer from the CPF investment account to ordinary account, so not to lose an extra month of CPF OA interest. But if we forget to do the transfer, yeah, so that's the risk, when we buy a T-bill that's in the second half, that has its auction in the second half of the month. Okay, so I've already placed my order for the T-bill, but only using cash and SRS money. Okay, I forgot. So that wasn't the last item. The last item is actually some technical analysis. Because there's a lot of interest in the banks now, right? So there are people who say, should I buy DBS stocks now? I think there's a lot more interest in DBS than UOB or OCBC, right? Well, DBS stock price has gone up a lot despite its bonus issue and of course the dividend that is paid. I think there is resistance at about $37 per share. Right, I think $36 looks like it's going to. There's a good chance of $36 breaking because the momentum is quite strong, right? If you look at the momentum oscillators, so if that goes, then we get C37. But 37 is resistance, so there isn't a lot more upside, right? If we are trading, right? But if we are investing, personally, I don't like to buy at such a high price. If I'm not already invested, right, I might take a nibble, right? But I'm already substantially invested. So if I want to buy more, right, I would wait for a pullback, and I see a gap, I see a gap at about 34 something, almost $35 a share. I see a gap in the chart. So it gapped up, maybe 2 weeks ago, it gapped up. The share price gapped up. So and gaps usually they get filled. They will get filled from my experience. I think they get filled. So there could be a pullback. If there's a pullback, we could see the price falling back to below $35 per share and filling the gap. So that could be a good place to buy more if we are interested in buying more DBS shares. Okay, so that's all for this video. Until next week, I'll take a week break. Okay, not too so long till June. If AK can do it, so can you. Bye bye.